This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back to Macro Analytics, and welcome to 2014.
Morning, Gord. Great to be back.
We're going to talk about your new book, The Money Bubble, and I have the picture of it up here on the slide right now. And so I thought I'd share today with our listeners an overview of the book. We will continue from session 1, already in progress.
So the question becomes, how does it unravel? You know, because we know it's going to, but we don't know exactly how we get from here to there. So we in one section of the book, we talk about different scenarios. You know, one of the interesting things about this thing going on longer than it should have been able to is that it has allowed a lot of people to come up with some very interesting theories about what happens next, about how it all blows up. So we include some of the better ones in section 3 of the book, and among the interesting theories are the shrinking trust horizon and the crack-up boom. And that's the process by which people just lose trust in the big systems. You know, in the U.S., the government and the big corporations and almost basically any other national and international system that we used to think worked for our benefit, we now see does not. You know, they're spying on us, they're debasing the currency, they're shrinking the size of packages and lying to us about it. And people are figuring this out. And the horizon by which they define who they can trust is shrinking back towards family, hometown, local government, etc. And the biggest system that we're losing trust in, or that we will lose trust in, is the currency. You know, when people lose trust in the dollar as a vehicle through which they can save for the future, then they just dump dollars when they get paychecks. You know, they turn it into real stuff. And this is, in Austrian economics, called the crack-up boom. It's when not so much the supply of a currency increases exponentially, but the demand for it collapses. Nobody wants to hold it anymore, so everybody buys stuff with currency as soon as they get it, and this pushes prices up. So it manifests as hyperinflation, but it's really a collapse in faith in the currency. That's one way it could go. And another way is currency war. Jim Rickards' classic book of a few years ago outlines this, and that's a scenario where the countries of the world are over indebted, and each of them comes to the conclusion that the only way out is to depreciate their currency, which they do. They gain a temporary trade advantage, but that disadvantages their trading partners, who then have to respond in kind, and you get a race to the bottom in currency values. And that's ongoing right now. You're seeing the yen and the dollar drop dramatically versus the euro, and Europe is dropping into recession, so they're going to have to dramatically lower the value of the euro pretty soon, and it'll go back and forth. And so we're headed that way for sure. Another interesting theory is the variable rate world death spiral. And that's where low interest rates of the last few years have seduced governments and individuals and corporations into either taking on a lot of variable rate debt or borrowing short term, 6 months, a year, 2 years, and then rolling that debt over frequently. And that's to take advantage of extremely low short-term interest rates. But if interest rates go back up, which they're going to have to if quote-unquote normal times return, then everybody's interest costs just explode because they've got to roll their debt over at higher and higher rates. And, just a return on the 10-year Treasury yield to normal yields of say 6% in the U.S. would explode the government budget. It would cause our interest costs to go up to about $1 trillion a year. So you'd have a deficit of $1 trillion a year embedded in the U.S. budget that there's nothing we can do about. And Japan is even worse. They would absolutely blow up if interest rates went to levels anywhere near that. So the Fed is really in a box, or the central banks of the world are in a box, where keeping interest rates low requires them to flood the system with new currency, which causes even bigger asset bubbles, which are destabilizing, and pulling back and allowing interest rates to rise to normal levels will blow up the budgets of governments and corporations and individuals around the world. And there is no way out of this. Those are the only two solutions that they have for this.
This is like the housing bubble era, John, where everybody went from fixed to variable mortgages because it was a way of financing your house because you were making money on the capital appreciation in a house. And suddenly when rates went up, everybody was caught with these variable and they got killed in the housing.
Exactly.
But now we're doing it at a sovereign and country levels. And so say, well, will it go up? But here's the other side of the coin. All of the pensions, the trusts, the insurance companies, they all live off yield. And they're financing the unfunded pensions out there right now that baby boomers are going to retire on are based on some level of interest being paid into the eventual principal. And there's no interest, or it's very, very small. So if the interest rates don't come up, we're going to have a pension crisis of monumental proportions around the world. You're going to get it one way or the other. Does that make sense?
Oh, absolutely. And the pension funds and other big institutional investors are responding to this low rate environment by shifting to higher risk assets. They're putting more and more of their money into equities and junk bonds and things like that, and real estate, things that are basically cyclical, that will crash in the next market correction.
The biggest pension plan in the world is the Japanese, and they have just changed the board of directors and the policies because they're forcing them to take a much higher equity investment and invest in the Nikkei index versus the traditional bond market. So what we're forcing, John, is an asset bubble to increase, and by the way, that's increase in collateral values. But, at some point it's so disconnected from fundamentals that it has to implode. But that's what's going on is this chase. The risk is disproportionately high now.
Yeah, and the crucial thing to understand is that there aren't any good solutions now. We put ourselves in a position where if we keep doing what we're doing, something else blows up. And if we stop doing what we're doing, then and go back to normal, then all the risk that we've taken on becomes unmanageable. And that's it. There's no middle way here. And so it becomes just a question of how do things blow up? What's the path that we take to get from here to hyperinflation to another Great Depression?
So it's not a matter of how. It's not a matter of when. It's just a matter that it's going to occur. So the best thing to do is to figure out what to do about it now, to start implementing your insurance plan right now. Isn't that what your book is telling people to do?
Yes, but there are lots of different, because there are so many different ways to get from here to there, each one involves a different investment strategy. For instance, if we just continue to flood the system with cash, then we're liable to see a melt up in equities. And bond yields stay nice and low. At the same time, all these other asset bubbles are being blown up, and then we get a blow up out there 2 years from now or 5 years from now or whatever. But in the meantime, you can make a lot of money by betting on the bubble continuing, by buying stocks. On the other hand, if we pull back and try to diffuse these asset bubbles and let interest rates rise, then stocks will crash. And bonds will also crash because interest rates will go up. And so in that case, you want to be betting against stocks and against bonds. So it's a really high stakes game trying to figure out which of these scenarios is going to be the dominant one going forward. And I don't have a really good answer for this because they're all plausible. They all have a lot of internal logic, and each one of them could happen. So to prepare for something like that, you almost have to kind of straddle the fence at first. Maybe do a little bit of shorting of selected, say, financial stocks, and maybe bet a little bit against bonds, but at the same time, put a lot of money into hard assets, which will tend to benefit if asset bubbles blow up. There isn't a way to do this so everything you do is going to work, guaranteed. And so, as you talked about, you and I talked about before we went on the air, this is a nightmare for a typical money manager, because there are no real fundamental directions that you can take where what happens is almost guaranteed. There isn't a risk-free portfolio anymore out there that you can set people up with, because anything can blow up. And you don't know what it's going to be. Something is probably going to blow up, but you just don't know what it's going to be. It might be bonds, it might be stocks, it might be precious metals. There's no way to know in the short run.
John, I finished a paper called The Globalization Trap, and we extensively laid out everything you're talking about, and everything you mentioned, we believe will happen. Interestingly enough, as you were going through the possibilities, the key is the sequence in which they're going to happen and the degree to which they're going to happen and the timing of it. And one of the things we concluded is we knew we didn't have it right, but what we did believe we had are the signposts of what you need to look for as it's going along, so you can react to it, because it's going to be incredibly difficult, incredibly high risk going forward. But for those who can do it, there's going to be fortunes made and lost. It's going to be a very exciting time if you're on the right side of it. So, things like your book are the kinds of tools that our listeners need to be studying, so that they can see what's happening around them. Otherwise, the cues are there and you don't recognize them. You don't recognize what's really happening.
Yeah.
That's the best way of describing it. John, we have to wrap, but kind of closing comments you'd like to leave with the listeners of exactly why this is an important book for them to take the time to read?
Well, one of the commonalities in all the scenarios we just talked about is that capital controls will be part of them at some point. And there are already signs that the concept is spreading. And basically, Cyprus, most people know this story, but when some banks in Cyprus got into trouble lately, instead of the government bailing them out, the banks just took the deposits of a lot of their depositors and used that money to bail out the banks, or to strengthen the banks. And now that idea is spreading. The European Union has adopted a plan for it. The IMF is pushing a plan for it. Canada has even adopted a plan for bail-ins. When their banks get into trouble, they're going to go after depositors' money instead of asking taxpayers to foot the bill. And so our bank accounts are no longer our own in any kind of a crisis.
John, why would somebody keep their money in a bank today? It pays absolutely no interest. And if the bank runs into a problem, they take your money.
Why, indeed. Part of it is that people don't know yet. They don't really recognize this danger because it's not front page news, but it will be. And by that time, it may be too late, because your bank may already be in trouble, and you may already have had part of your savings account or whatever vacuumed up.
Well, the answer, people would come back to me and they'd say, well, if I don't have my bank account, I can't use my credit cards because that's where the money comes out. Or I can't write a check unless the money's there. So that's why where we're going to is the banks, in my opinion, John. It's only a matter of time before they're going to charge you to take your money on deposit versus you being paid for it. And I've seen that in various countries already happening.
Mm-hmm. Yeah. Well, the EU is now talking about doing a wealth tax where they take 10% of everybody's bank account just as part of their fiscal plan. And so that's sort of like banks charging you to have money on deposit. That's the way of hiding it.
Yeah. That's exactly. So they pay you half of 1%, but you pay it 10%. So you're paying for them to have the security of your money. And so you can use your credit card. It's part of moving to a cashless society. Great business for the banks.
So, Gord, the solution to this is to minimize the amount that you keep in standard financial institutions. You have to keep some cash, obviously, to be able to transact, but you don't have to keep your savings in a bank, and people are going to figure this out. And this is part of the impetus for the migration from financial assets to tangible assets. Because if you've got gold coins at home, that doesn't require anyone else to keep a promise. That's a tangible asset that is yours and yours alone. Your bank account now depends on the bank staying out of trouble and the government not just going in and looting banks. And so they have to keep their promises that your money is really yours. And increasingly, they're not keeping that promise. So real assets are going to become a lot more attractive going forward as people figure this out. And when it happens, it will happen on a big scale very quickly, because with global communications now, one group of people figure it out and start talking about it, then the idea is going to spread and everybody is going to think it's reasonable to pull money out of their banks. And then everything changes. Then the system just spins out of control. And that day is definitely coming. Maybe it's when the EU imposes a wealth tax. Maybe when it's a big U.S. bank getting into trouble and takes 1/3 of everybody's deposit, whatever. Something like that is going to happen out there. And on that day, if you haven't already instituted a lot of these changes in your financial structure, you're going to wish you had.
John, we got to wrap. There's just so much in your book that I feel like we didn't even begin to touch the surface here today. I recommend everybody go to the site here, click it on, and read up more of John's book and order it. John, can you tell our listeners where they could learn more about your site and your other offerings?
Yeah, run dollarcollapse.com. It covers a lot of what we talked about today, and it has some links to the book too, so you can buy the book via that site. It's updated daily.
For time, we have to cut, but I really would like to have you back again and to pick up on the book and take some of the chapters in it and talk more if possible. Maybe possibly have James Turk join us.
Yeah, that'd be great. I'll talk to James about it.
Anyway, until next month. Talk to you later.
Thanks, Gord.
Thank
See
you.
ya.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.